The average American carries a credit card balance of over $7,300. And as a nation, we racked up over $1.1 trillion of credit card balances. $1 trillion. That is a mountain of debt to climb over. So every headline on the news or every financial pundit, they're all screaming the same things. Crisis, collapse, thinking that we're about to have another 2008 where the entire system comes crashing down. But what if they're wrong? What if the bubble isn't going to pop? What if the rules of the game have changed so fundamentally that this mountain of debt can just keep growing? See, this isn't another video about a coming crash. This is a story about a very strange but very realistic new economic reality. So today we're going to do some due diligence. We're going to explore the hidden forces and the surprising new habits that are keeping this massive debt machine from blowing up, and what this new normal could actually mean for your wallet. To understand how bizarre this is, you need to go back and understand how things should be working. In a normal world where debt gets this high, you start to see signs of distress, and the biggest ones are delinquencies. Think of it like this. Debt is the fuel, but delinquency is the actual fire. And a delinquency is just when someone is late paying off a debt, most times by like 30 days, if not more. When delinquencies go up, people normally start struggling. Lenders get nervous, so they start to tighten up the money supply. And when things really get bad, you start to see a wave of charge-offs, which is just a fancy term for when your lender gives up on you making your payments and just writes off your debt as a loss. It's when you have too many of these charge-offs that you start to have a full-blown financial crisis. And the numbers, they're staggering. We're talking about having over $1.18 trillion of credit card debt as a nation, with the average person having a credit card balance of $7,321. If you take these numbers and just throw in the fact that the average credit card interest rate is about 20%, that means it would take the average person over 20 years to pay off their debt if they were just doing minimum monthly payments. So all the ingredients for a financial disaster are right there in front of us. We got record high debts, extremely punishing costs for having these debts. So by the old playbook, we should have record high delinquencies by now, but we don't. In a surprising turn, the 30-day delinquency rate actually fell for 3 straight quarters, down to a little more than 3%. Now, this does come after a period of increases, but still, this is the real mystery. We're borrowing more money as a country than what we ever had before, yet at the same time, on paper, it looks like we're managing it better. How is that possible? The answer isn't just one simple thing. It's actually a mix of new technology, shifting behaviors, and a quiet rewriting of the rules of money. The first piece of the puzzle, and arguably the most important, is the explosion of what's called phantom debt. These are debts that act like credit, look like credit, but often don't show up in the places where credit is usually seen. These things are everywhere, giving you the ability of taking bigger purchases and splitting them into smaller, more palatable payments. So those $200 sneakers now feels more affordable because you can break them up into 4 $50 payments. And the global market for these services are expected to explode, going from $230 billion last year to projecting to have over $1.4 trillion in market value by 2029. Heck, in 2022 alone, 1 in 5 Americans who had a previous credit profile admitted to using buy now, pay later services at least once. But here's the crucial part. These buy now, pay later or phantom debt services, they haven't been consistently reported to the big credit bureaus. This means you could be juggling multiple BNPL loans without a single one hitting your credit score. And because it's not hitting your credit score, it's not showing up on these delinquency reports that economists constantly check on. You could be late on a Klarna payment or 3 months late on that Affirm payment and not have that affect that 3% delinquency figure at all. But who's using these services? Mainly consumers. Primarily younger consumers who have low to no credit scores at all. In fact, the Consumer Financial Protection Bureau, or CFPB, found that BNPL users are more likely to have subprime credit and carry higher balances on their regular credit cards. So they're basically using BNPL to manage their cash flow so they don't max out their visas. And I'll be honest, I was one of those people. When I first moved to this apartment, I was still paying an $8,000 credit card debt on my Discover It card. And because of this, I was using Klarna to finance everything from my mattress, to my couch, to my $2,000 gaming PC. Basically, BNPL is being used kind of like a pressure release valve. absorbing a lot of the purchases that would normally go on standard credit cards and artificially pushing down on delinquency rates. The debt is still there, but it's being hidden in plain sight. So on the one hand, you have the phantom debt, but there's another piece to this puzzle. It's honestly a question. Are people just getting smarter with managing money? See, it's tempting to believe that people are just being reckless with their purchases, but the data shows that there's something a little more nuanced going on. See, a lot of consumers are getting more smarter and more strategic with the way they handle their debts. While there is some evidence that there are more people at the brink of delinquency, the rate at which they pay their balances have been higher than pre-pandemic levels for years, only just recently getting back to 2020 levels. You have to think if the trauma of the 2008 financial crisis mixed with the pandemic of 2020 kind of instilled a little bit of fear and caution into us when it comes to money. Then you have the technology. Things like budgeting apps, digital banking, automatic payment reminders. This gives us a level of financial control that the average person didn't have just 10 years ago, thus giving us more power to track our money and to actually stay on top of our debt. Speaking of the banks, they're actually being a little bit more strict and not just handing out credit cards to everybody. They're being more selective, but while the data on origination rates from subprime borrowers isn't always clear, that's where BNPL steps in, accepting the applications of nearly 80% of people who have either subprime or extremely subprime credit profiles. So when you start shifting high-risk applicants over to a more parallel credit system, it makes the delinquency rates look better on paper, even though those same applicants are still borrowing more than ever. So you have these two realities going on at the same time. On one hand, you have a group of borrowers, the subprime ones, who are struggling and leaning on things like buy now, pay later. And on the other hand, you have the prime borrowers who are being more cautious with their money and keeping track of it a lot better. And adding these two things together give you the key to why this current financial system hasn't broken yet. So look, this creates a fascinating yet also precarious new landscape for your money. We're navigating this new world of visible versus invisible debt and trying to make sense of the signs that seem to contradict each other. So if you're finding this breakdown valuable and want more content that cuts through the noise of the economic headlines, do me a favor, hit that thumbs up button and the subscribe button. And that lets me know you want to see more deep dive videos just like this one, but let's get back to it. So the reality is the bubble is not popping, it's just stretching. But what does this stable instability actually mean for you? First, the good thing, and let's be fair, the rise of BNPL actually gives you another tool for managing your money. If you use it right, the services can be a legitimate, easy way to put big purchases on a payment plan without having to put it on a high interest credit card. But the risks are profound. The ease of buy now, pay later makes it completely easy for us to impulse shop, and because you could take out multiple loans at once, it's easy to find yourself in over your head with monthly payments. And believe me, it's incredibly easy to lose track when you have 3 payments going to Afterpay, 4 payments going to Klarna, and 5 payments going to Affirm all at the same time. And I'm not alone. According to the CFPB, 3 out of 5 borrowers held multiple loans at once, to the point that this has now become a thing called loan stacking. But there's a bigger, more systemic risk, and that's the lack of transparency. Because of this, they might give you a loan on things like a car or a mortgage, not knowing you have thousands of dollars more in debts that they can't see. And it's this hidden leverage that makes the entire financial system vulnerable. But the walls are starting to close in on this. And that's because bureaus like FICO, Equifax, they're not blind. They're actively working to pull this buy now, pay later data into their credit score reporting. In fact, Affirm has already started reporting payment histories to bureaus like Equifax. Meanwhile, FICO is set to release new scoring models this fall to account for buy now, pay later. And when that happens, those phantom debts will no longer be invisible. So for those of us who have been using it responsibly, hey, it's a boost in our credit scores. But for the ones who have been stacking up BNPL loans and barely keeping up with the payments, they could find their credit scores crashing down to the point where they get kicked out of the very system that they've been relying on. So we find ourselves in this paradoxical moment. The mountain of debt has never been higher, but at the same time, the alarms of mass default is strangely quiet. This new ecosystem led by the buy now, pay later movement has created a shadow debt system that masks the traditional signs of distress. And at the same time, you have a mix of evolving consumer behaviors and stricter banking procedures that are keeping the official numbers in check. And adding all of these things together have resulted in a debt bubble that won't pop because it's artificially designed to stretch. But this elasticity does come with a cost. It creates new ways to get into debt, fosters a concerning lack of transparency, and it builds hidden risks that are only now starting to be understood. So the question is no longer when will this bubble pop? The question now becomes what happens when this artificially stretched out, distorted reality becomes the new norm of our economy. Now I want to hear from you. What are your experiences with these new forms of debt? Have they been a helpful tool for you, or do you feel like they're kind of a trap? Let me know in the comments below. And if you want to learn more about buy now, pay later services, check out this video here.